On August 14, 2001, the chief executive officer of America's seventh largest company abruptly resigned, citing personal reasons after only 6 months on the job. The company was Enron, a corporate titan celebrated for revolutionizing the global energy market. Wall Street analysts were baffled by Jeffrey Skilling's sudden departure, but behind the gleaming glass facade of the company's Houston headquarters, a financial time bomb was ticking. For 6 consecutive years, Fortune magazine had named this energy conglomerate America's most innovative company. It had transformed from a traditional natural gas pipeline operator into a massive trading platform, buying and selling electricity, broadband bandwidth, and even weather futures. This aggressive pivot created an aura of invincibility, drawing billions of dollars from institutional investors and retail shareholders alike. The late 1990s and early 2000s provided the perfect macroeconomic environment for this explosive growth. Deregulation in the energy sector opened new markets, and the booming dot-com era rewarded companies that promised revolutionary asset-light business models. Investors were eager to believe in a new economy where trading complex financial instruments generated massive wealth, allowing the Houston-based firm to position itself as a visionary technology company rather than a stodgy utility. Yet, that aura of visionary success was entirely manufactured. The foundation of this sprawling business empire rested not on tangible assets or legitimate profits, but on a labyrinth of financial illusions. When the truth finally surfaced, the resulting shockwaves would obliterate billions in shareholder value, destroy thousands of careers, and fundamentally rewrite the rules of global corporate governance. The architecture of this deception began with a fundamental shift in how the company recorded its revenue. In 1992, regulators granted the firm permission to use mark-to-market accounting for its natural gas trading business. This accounting method allows a company to record the estimated future profits of a long-term contract on the very day the deal is signed, regardless of whether any actual cash has changed hands. If the actual revenue from those contracts eventually fell short of the initial projections, the company was supposed to adjust the numbers downward. Instead, executives simply wrote new contracts, booking even more hypothetical future profits to mask the shortfall from the old ones. This created a relentless, insatiable demand for new deals just to keep the stock price climbing and the illusion of profitability alive. The drive to manufacture revenue extended far beyond creative bookkeeping and directly impacted everyday consumers. During the California electricity crisis of 2000 and 2001, the company's traders actively manipulated the state's power grid. By artificially creating energy shortages, routing power out of the state and back in to avoid price caps, they drove electricity prices to unprecedented heights, reaping massive profits while rolling blackouts paralyzed millions of residents. But even manipulated trading profits and hypothetical revenue could not pay the bills, and the conglomerate was rapidly bleeding cash while accumulating massive debt to fund its aggressive expansion. To hide this growing financial black hole, Chief Financial Officer Andrew Fastow engineered a network of off-balance sheet partnerships known as Special Purpose Entities, or SPEs. These were essentially shell companies created solely to conduct business with the parent corporation. By transferring underperforming assets and staggering debt into these SPEs, the primary corporation kept its own balance sheet looking pristine. Because the parent company technically owned less than 50% of these external entities, accounting rules at the time did not require their toxic liabilities to be reported in the main financial statements. It was a sophisticated shell game designed to project unstoppable growth while burying catastrophic losses. The broader financial ecosystem eagerly accepted these pristine numbers without looking too closely at the underlying mechanics. Investment banks, hungry for lucrative underwriting fees, continued to issue glowing reports and recommend the stock to their clients. The entire market was blinded by the relentless upward trajectory of the share price, willfully ignoring the increasingly opaque and convoluted financial disclosures. This systemic failure of oversight extended to the very institution tasked with protecting the public interest. Arthur Andersen was one of the world's top 5 accounting firms, serving as both the external auditor and a major consultant for the energy giant. This dual role created a massive conflict of interest that fundamentally compromised the integrity of the auditing process. In the year 2000 alone, the auditing firm earned $25 million in audit fees and $27 million in consulting fees from this single client. Pushing back against aggressive or questionable accounting practices threatened not just the audit relationship, but the even more lucrative consulting contracts. The gatekeepers had essentially become business partners, signing off on financial statements they knew, or should have known, were deeply flawed. The facade finally began to crack in the late summer of 2001. A mid-level executive named Sharon Watkins wrote an anonymous memo to the company's founder, Kenneth Lay, warning that the corporation would implode in a wave of accounting scandals. Her internal whistleblowing highlighted the perilous nature of the off-balance sheet partnerships and the terrifying reality that the company's equity was propping up its own debt. Panic quietly spread through the executive suites, even as leadership continued to publicly assure employees and investors that the business was stronger than ever. Behind closed doors, insiders began quietly liquidating their stock options, extracting millions of dollars in personal wealth. Meanwhile, a routine regulatory inquiry into the company's complex partnerships soon escalated into a formal investigation by the Securities and Exchange Commission. On October 16, 2001, the company announced its first quarterly loss in over 4 years, taking a massive $1.01 billion charge related to its investments. Shortly after, it disclosed a $1.2 billion reduction in shareholder equity, an admission that sent shockwaves through the financial markets. The stock, which had traded as high as $90.56 a share just a year earlier, began a catastrophic freefall. Desperate attempts to secure a buyout from a rival energy firm collapsed when the true depth of the financial rot was exposed. On December 2, 2001, the once mighty energy titan filed for Chapter 11 bankruptcy protection. At the time, it was the largest corporate bankruptcy in the history of the United States, wiping out $74 billion in shareholder value almost overnight. The fallout extended far beyond the trading floors of Wall Street, inflicting devastating damage on ordinary people. Over 4,000 employees lost their jobs immediately, but the true tragedy lay in the destruction of their retirement savings. The company had aggressively encouraged its workforce to invest their 401k plans heavily in company stock, matching their contributions with even more shares. As the stock price plummeted towards zero, executives temporarily froze the employee retirement plan, citing a change in administrators. This administrative lockdown prevented workers from selling their plummeting shares, trapping their life savings in a dying company. While top executives walked away with fortunes secured prior to the collapse, rank-and-file employees lost an estimated $2.1 billion in pension wealth. The sheer scale of this corporate greed and deception demanded an aggressive legislative response. The public trust in the financial markets had been severely fractured, prompting lawmakers to fundamentally restructure corporate accountability. In July 2002, the United States Congress passed the Sarbanes-Oxley Act, a sweeping piece of legislation designed to prevent such catastrophic fraud from ever happening again. This landmark act mandated strict reforms to improve financial disclosures and prevent conflicts of interest. It explicitly prohibited auditing firms from providing certain consulting services to the companies they were auditing, directly addressing the conflict that had compromised Arthur Andersen. Furthermore, it required senior executives to personally certify the accuracy of their financial statements, attaching severe criminal penalties for signing off on fraudulent reports. The implementation of these new rules forced a massive cultural shift across corporate boardrooms globally. Boards of directors could no longer claim ignorance of the financial engineering occurring beneath them. Independent audit committees were suddenly empowered, and the cost of regulatory compliance surged, fundamentally altering how public companies managed their internal risk and reported their earnings to the public. The consequences for the complicit gatekeepers were equally severe and immediate. Arthur Andersen was indicted for obstruction of justice for shredding thousands of documents related to the audit. The conviction effectively destroyed the 89-year-old firm, reducing the global accounting oligopoly from 5 major firms down to 4, and leaving tens of thousands of its own employees jobless worldwide. The architects of the deception also faced a harsh reckoning. Jeffrey Skilling and Kenneth Lay were indicted on dozens of counts of fraud, conspiracy, and insider trading. The subsequent trials laid bare the toxic culture of arrogance and the relentless pressure to meet earnings targets at any cost, ultimately resulting in convictions that sent a chilling message to corporate suites everywhere. Yet, unpacking this monumental failure reveals a persistent tension at the heart of modern capitalism. The drive for continuous, aggressive growth constantly incentivizes executives to push the boundaries of financial reporting. While regulations can mandate transparency, they cannot entirely eliminate the human temptation to obscure risk in pursuit of short-term market rewards. The legacy of this collapse is a permanent cautionary tale about the illusion of complex financial engineering. It demonstrated that when corporate ethics are subordinated to stock price manipulation, the resulting damage ripples outward, destroying not just shareholder wealth, but the livelihoods of thousands of innocent workers. The destruction of trust is a cost that no balance sheet can accurately measure. Deconstructing the Enron scandal reveals exactly how a singular obsession with the appearance of success can rot a business from the inside out. The mechanisms of the market have evolved and the regulatory guardrails are higher, but the core vulnerabilities exposed in that era still echo through global finance. Understanding this spectacular downfall is essential for recognizing the fragile architecture of trust that underpins the modern economic system.